Hello everyone. In today's video, we're breaking down one of the more unique ETFs on the market, the JPMorgan Hedged Equity Ladder Overlay ETF, ticker HELO. It's designed to give you equity exposure like the S&P 500, but with lower volatility and downside risk using a ladder option strategy. In this video, I will cover how HELO works, what it actually holds, the risks, the costs, and the associated yield, and what type of portfolio it belongs to. Stay until the end because I will explain who can benefit the most out of this ETF. So let's dive in. So let's talk about the strategy and the purpose. HELO is built for investors who want some market upside with less volatility and drawdown. This is important for investors that are in or closer to a time when they are planning to withdraw funds from their portfolio. Making withdrawals from a shrinking portfolio can really damage your principal in ways that are almost not recoverable over time. HELO invests in large cap US stocks but overlays with a ladder options strategy to reduce risk. So here are the key points. It seeks to participate in equity growth but limits both upside and downside. It uses put spreads plus cover calls on S&P 500 equities in a staggered 3-month intervals. I will try to explain in simple terms what this means later on. So the goal is a much smoother ride, especially in downturns. And we are lucky that we have faced a downturn recently because we will see how HELO actually delivered. So let's talk about the impact of drawdowns in a portfolio. So why is it important for some investors to have a better downside protection? Let's take a look at a couple of tables that illustrate the impact of drawdowns in two scenarios, with and without withdrawals. These represent two different phases in the investing life cycle. A first phase where we accumulate wealth and we don't touch the principal, and another phase, the retirement phase, where our investment becomes our main source of income and we begin to withdraw funds from them. So these two tables try to illustrate this scenario. You can see in the table above the portfolio recovery time with no withdrawals and a 7% growth rate, and the table below the portfolio recovery time with 4% withdrawals and a 7% growth rate. So in the first table, you can see what is the impact of different drawdown scenarios with a 10%, 25%, and 50%. With a 10% drawdown, it will take 2 years to recover, to be or to come back to the same point where the drawdown started. With 25%, it will take 5 years, and with 50%, it will take 11 years. Now, if we are in the retirement phase, in the withdrawal phase, it will take 4 years to recover from a 10% drawdown. It will take 10 years to recover from a 25% drawdown, and it will take 24 years to recover from a 50% drawdown. So as you can see, these drawdowns can have a huge impact on your portfolio in ways that are almost not recoverable, as I said before, and this is where HELO comes in. So let's talk about what HELO does, and let's deep dive a little bit on the ladder option strategy. HELO is designed to smooth out the ride. It tries to give you part of the stock market upside while protecting you from the downside. It does this by combining two things: a normal portfolio of big, well-known US companies like Apple, Amazon, Microsoft. A protective shield built using options is a kind of like an insurance policy. And here is the ladder part comes in. Instead of renewing that protection every few months all at once, like renewing car insurance once a year, HELO spreads it out. It has 3 layers of protection, each set to expire at different times, like 3 overlapping umbrellas. One renews every month, so there is always something active and always something fresh comes in. Imagine this timeline. Month 1, umbrella A opens. Month 2, umbrella B opens. And month 3, umbrella C opens. And month 4, umbrella A is renewed, and the cycle continues. This reduces the chance that the protection expires right before a crash. Why does this matter? With this setup, you're never fully exposed. At least part of your portfolio always has some protection against drops. But, and this is important, just like insurance has a deductible and doesn't cover everything, this protection doesn't cover small dips. And if the market goes way up, you might not capture all the gains. But the trade-off is more stability, especially helpful during big drops. And we, again, as I said before, we've been lucky to have had one of those big drops recently, so we can really test the portfolio, how it behaved. So now let's talk about the holdings breakdown. HELO's equity portfolio mirrors the S&P 500, but with modest tweaks using JPMorgan's valuation model. The top holdings are Apple with a 6.7%, Microsoft with a 6.6%, Nvidia with a 5.9%, and then there is Amazon, Meta, Alphabet, Berkshire Hathaway that we talk about in this video that I will leave in the comments, Visa and MasterCard. So the sector allocation is tech heavy with a 28.8% of technology in the portfolio. And in this chart, we can see the sector allocation versus the S&P 500. As you can see, and as I said before, information technology stands out with a 28.8%, very similar to the S&P 500. In this case, is the Spider with a 30%. Consumer discretionary is 11%, very similar again with the Spider, which stands at 10.35%, and the rest of the allocation is quite similar to the S&P 500, actually very similar. So as you can see, it holds 160 positions and is still very diversified, but tech exposure is material. So let's talk about performance and volatility. HELO launched in late 2023, and as of May 2025, its net asset value is about 59.99, but it's down 4.08% year to date. Now let's take a look at the overall performance in comparison to the S&P 500. With a starting balance of 10K, we would have received a CAGR, an annualized return of 9.39 with HELO, and the S&P 500 would be 13.59. You can see here two interesting numbers, which is the worst year and the maximum drawdown. Bear in mind that these don't take into consideration the April drawdown, and we will deep dive into this one later on. But the worst year with HELO would have been about 4.5%, and the S&P 500 or Spider would have been 5.1%. The maximum drawdown, 5.8% and 7.58% for the S&P 500. But again, bear in mind that this doesn't have into consideration the latest drawdown, which I will explain in a minute with more detail. And here we can see the two charts of the latest bear market, which was very short in time, but it was quite deep. It was almost 20% in the S&P 500. But we can see that HELO actually took a hit of about 11% from the peak, and the S&P 500 took a hit of about 19%, almost 19% from the peak. So HELO has been hit by 58% of the S&P 500 losses during the bear market, and this is an important number because what we want to see here is the hit by a bear market versus the gains that HELO can capture during a bull market. And if we go back to our table where we can see the annualized return, we see that the annualized return for HELO was 9.3% and the annualized return for S&P 500 was 13.59%. So HELO has been able to capture 70% of the S&P 500 gains. So again, it has been hit by 58% of the losses in the S&P 500 in comparison to the S&P 500 in the latest bear market, and it has been able to capture 70% of the S&P 500 gains. Now, with these two numbers, with being hit by about 58% of the S&P 500 losses and being able to capture about 70% of the gains in the S&P 500, let's do a simulation. How would HELO compare to the S&P 500 with these two assumptions over a period of, say, 20 years? Let's take a look at it. And here is my simulation that I run over a period of 20 years with the two assumptions. Obviously, we can't guarantee that this will happen in the future and these assumptions will hold, but it's a good starting point, I guess. And over a period of 20 years, I did a simulation with four bear markets. There is a bear market, as you can see here, of about 10% in year 3, of about 20% in year 7, 25% in year 12, and about 40% in year 18. So over this 20-year period, the market has been beaten up pretty good. And if we take a look at the comparison, you can see here, the first column is the S&P 500 with no withdrawals. The second column is the S&P 500 with a 4% withdrawal rate. And the fourth column is the HELO ETF with no withdrawals, and the HELO ETF in the fourth column with a 4% drawdowns. So you can see that up to year 12, they hold, so you can see that, the two compensate more or less each other up to, if we take a look at year 3, HELO is slightly higher. So every time there is a drawdown, HELO seems to go ahead of the S&P 500. If you look at year 3, it's slightly higher. Then the S&P 500 recovers up to year 6 because of the better returns. And then in year 7, there's another hit in the market, and HELO goes ahead again. Then up to year 11, the S&P 500 goes ahead by about 50K, but then the 25% drawdown comes in, and there is a hit in the ETF, which becomes ahead or goes ahead by about 100K. Then the same happens up to year 17. The S&P 500 goes slightly ahead. It doesn't recover all the gains that are captured by HELO from the latest drawdown. And then in year 18 there is a massive market drawdown with a 40% drop, and then HELO comes in forward if both with withdrawals and without withdrawals. So the end balance is actually better, as you can see here in HELO, up to 20 years, with more than $1 million in the case of no drawdowns, and a little bit less than $1 million in the S&P 500 with no drawdowns. And with drawdowns, again, HELO is ahead as well by about 100K. So pretty good results, taking into consideration there are pretty strong bear markets along the way. Now, despite the options overlay, HELO isn't a high-income fund. The 30-day SEC yield is about 0.76%. The 12-month dividend yield is about 0.65%. So don't go to this ETF if you want to have high dividends or high yields. So this is not likely a play like JP or Devo. It's more about risk-adjusted returns than cash flow. In terms of costs, HELO has a 0.5% expense ratio, which is on the high end for me, but I guess fair for an actively managed strategy with options overlay. And as I said before, there are risks, and you should be aware of these risks. There is no free lunch, and there's risks and trade-offs. So the first one is the option strategy risks. It limits upside in bull markets, which we have seen. Its hedging may not work perfectly well during shallow pullbacks. And obviously there is sector concentration risk. Tech still dominates and could underperform in a tech downturn. And it can really underperform in calm markets. In sideways or gently rising markets, HELO may lack and hedge strategies. So is HELO worth it? If you want to reduce downside risk in your equity sleeve and you're willing to trade off some of the upside, HELO can make a lot of sense, especially as a core satellite holding in a defensive portfolio. But if your goal is maximum total return or monthly income, there are other tools that are better suited to that. So the best cases that I can think of for HELO are the following. So first of all, paired with a traditional S&P 500 exposure. Also in a retirement or capital preservation strategies, as we saw before in the simulation. And when volatility is expected to rise as well. So personally, I use HELO as part of my hedge equity sleeve. And I like it for investors who want to stay in the market but don't want the full roller coaster. Now let me know in the comments if you have used HELO or have any hedging strategies in your portfolio that I would like to comment in my videos. Thank you, and see you in the next video.